Hi everyone, welcome back to our page, and this video I will be discussing a certificate for options. Now, with an employee stock option plan, you are offered the rights to buy a specific number of shares of company stock at a specified price called the grant price. Also, the exercise price or strike price within a specified number of years. Your options will have a vesting date and an expiration date. You cannot exercise your options before the vesting date or after the expiration date. Your options are considered to be in the money when the current market price of the stock is greater than the grant price. Now, I am going to discuss a summary of terminology that you will see in your employee stock option plan. For example, a grant price, exercise, or strike price is the specified price at which your employee stock option plan says you can purchase the stock. Then you have the issue dates, which is the dates the option is given to you. You also have a market price, the current price of the stock. Then you have vesting date, the dates you can exercise your options according to the terms of your employee stock option plan. Also have exercise dates, which is the dates that you do exercise your options. Then you have an expiration date, which is the dates by which you must exercise your options or they will expire. Now, there are different types of options. So I'm going to discuss mainly the two types of stock options company issues to the employees in South Africa. You have the NQs, which is the non-qualified stock options. Then you have the ISOs, the incentive stock options. Now, there are different tax rules which apply to each type of option. With a non-qualified employee stock option, taxes are most often withheld from your proceeds at the time you exercise your options. That is not necessarily the case for incentive stock options. With proper tax planning, you can minimize the tax impact of exercising your options. Now, your employee stock option plan will have a plan document that spells out the rules that apply to your options. You need to get a copy of this plan document and read it, or hire a financial planner that is familiar with these types of plans to assist you. There are many factors to consider in deciding when to exercise your options. Investment risk, tax planning, and market volatility are a few of them, but the most important factor is your personal financial circumstances, which may be different than those from your co-worker. It is important to keep the following in mind before following anyone's advice. The first question you would ask yourself is, should you keep the stock? Keeping too much company stock is considered risky. When your income and a large portion of your net worth is all dependent on one company, if something bad happens to the company, your future financial security could be in jeopardy. Now, corporate executives need to consider this in their planning and work to diversify out of company stock. Company share option plans, the CSOP, which is a tax-qualified discretionary option plan under which a company may grant options to any employee or full-time director to acquire shares at an exercise price which must be not less than the market value of the shares on the grant date. The exercise is generally tax-relieved, allowing gains to be taxed as capital on the sale of the shares. Now, the conditions hereof: in order to qualify for beneficial tax treatment, a company share option plans must meet requirements in respect of, firstly, eligibility of individuals to participate, secondly, shares which may be subject to option, and then thirdly, limits and self-certification. Now, eligible employees, who are they? Options may be granted on a discretionary basis to any employee or any full-time director of the establishing company, or any constituent company in the case of a group plan. If the establishing company is a closed corporation, participants are ineligible if they or their associates have or have had within the previous 12 months a material interest, broadly 30% of the ordinary share capital or assets in the company. Now, plan shares must be fully paid up, and it is non-redeemable ordinary shares which are in an independent company or listed on a recognized stock exchange. Then plan shares qualify if there is only one class of shares in issue. If there is more than one class in issue, the majority of the shares of the same class as plan shares must be either employee control shares or market or open market shares. Shares will be employee control shares if employees and directors and former employees and former directors control the company by virtue of holding shares of the same class as plan shares. Shares will be open market shares if broadly the majority of shares of the same class as plan shares are not held by persons who acquired them by reason of their employment or directorship, or by trustees who hold such shares on their behalf. Since the 17th of July 2013, plan shares may be subject to restrictions. So, for example, it is possible for unlisted companies to require CSOP options holder to enter into a power of attorney which allows the attorney to exercise the option and to sell the option shares on their behalf should an exit be achieved. And that is it for this video, guys. If you guys want to know more about share options, please do visit our website www.𝗪𝗲𝗀𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋𝗋 also follow us on all our social media platforms, that is Facebook and Instagram and Twitter. Give us a thumbs up on YouTube, like and subscribe to our channel, and stay tuned for more videos like this.